For the last 1.5 years, the Fed's main mission was to crush inflation. And the only way they could do that was to jack up interest rates and to slow the economy down. So the stock market had to constantly fight the Fed, who was trying to push it down, and it was really challenging for investors. But on Wednesday, everything changed forever because the Fed finally acknowledged that inflation is under control. They are no longer going to raise interest rates. In fact, they're going to cut interest rates to support economic growth. So now all of a sudden, the Fed is a friend of the stock market again. So what does it mean for us as investors? If you recall, just 1 month ago, what was the Fed chairman saying? He was saying that we're going to keep interest rates higher for longer, and no, we are not even going to talk about rate cuts. But now what happened? Less than 1 month later, he's more fickle than my wife. He said, oh, okay, we are going to cut interest rates. And now everything has changed. Now, those of you who have been following me on YouTube and my subscribers, you know that a month ago, we knew that they were bullshitting, that rates had peaked, they were going to cut rates already. And how did we know? We look at the 10-year Treasury yield, and we got a lot of clues by looking at the technical chart patterns. You can see just over a month ago, we saw that double top pattern on the 10-year yield. And those of you who have taken the price action manipulation caused by Alson Chu know that we call that a forced top bull trap pattern, right? So that was a time that we were going to short the 10-year Treasury yield and hence long the long-term Treasury bonds, which is the TLT. Again, if you follow my YouTube videos, you know that I went long on the TLT very early over here using options. So since then, I have sold half my position. I have the other half remaining because I think that it could still run quite a bit more to the next year. So over here, you can see my alert that was sent out to my subscribers on the 8th of December. Yep, just closed and took profits on my TLT bullish synthetic position. And this represents half my entire long position. So I still have half my position left in TLT, which I'm letting it run. And you can see it over there. That's my TLT synthetic position. It's about right now 5,008 in profits. So letting that run to the next year. So let's analyze what happened last Wednesday that changed the entire narrative of the stock market. So Fed Chair Powell, for the first time, he acknowledged that inflation was under control and that the economy was slowing down. So the committee was penciling in 3 rate cuts next year and more rate cuts in 2025. So based on the FOMC committee, their projections are that the short-term interest rates we cut by quarter percentage points 3 times next year, down from 5.25% to 4.5% next year. But the market doesn't believe it. The market, in fact, is pricing in 6 rate cuts next year. So the market is expecting a rate cut down to 3.75%. Now, who's right? No one knows. We can't predict for certain. But they are also projecting that by 2025, the short-term interest rates should come back down to 3.6%. So the market reacted ferociously to the news. The first thing that happened was that the 10-year Treasury yield collapsed. You can see it broke all the way down below the 200-day moving average. So the long-term interest rates are coming down. And that is great news for certain sectors. Now, if you recall, for the last 1 year during that bull run, which by the way I called early last year, which many people didn't believe, right? That bull run in the S&P 500 was driven, as you guys know, mainly by the Magnificent Seven, less Tesla. Because Tesla is a car company, they need low interest rates to do well. But besides Tesla, all the other Magnificent Seven like Amazon, Nvidia, Meta, Microsoft, Google, they are interest rate proof. So they do well whether the rates are high or rates are low. So they were the ones that were leading the bull market over the last 1 year. And thank goodness most of my portfolio are in that Magnificent Seven. But as you guys have noticed, during that bull market of the last 1 year, not all stocks went up. Only those tech stocks went up that were immune to interest rates. But companies and sectors that depend on low interest rates continue to suffer. They never recovered, like real estate, like REITs, like bonds, like small caps, like industrials and financials, they kept getting beaten down for the last 1 year. But on Wednesday, everything changed. Suddenly, all these stocks and sectors that were beaten down, they started coming alive. So financials started rebounding, small caps rebounded, industrials rebounded, bonds rebounded, real estate rebounded, and REITs rebounded as well. You can see how in the last 1 week and the last 1 day, how the other sectors are now begin to play catch up to the tech stocks that were initially leading the bull market. You've got real estate, the strongest performer in the last 1 day, energy, basic materials, industrials, consumer cyclicals, financials. So again, these sectors are the most cyclical and they are the most sensitive to interest rates. Where interest rates go down, they do very, very well. When interest rates went up, they did not do that well. And take a look at these charts. So again, you can see initially the S&P 500 was driven by these main 7 tech stocks. But since then, we've got the rest of the S&P 500 as measured by the equal weight S&P 500 that is beginning to catch up. The other 493 stocks are joining the bull market after 1 year. And there you are. This is another chart showing you how the industrials have begun to outperform right now. Small caps, the small companies, the financials, and the REITs, and of course the bonds. What does this mean? This means that the bull market is getting stronger because everyone's joining the party. The bears for the last 1 year have been complaining, it's not a real bull market because only 7 stocks bring up the market. Well, now you have everyone joining the party. You have got the broadening of the breadth of the entire market. So now, of course, the question is, does this bull market have legs? Are we at just the beginning of a much longer sustained bull run? Well, first of all, I think that for the rest of the year, we should continue to be bullish because the momentum is very bullish. We are still on a very clear uptrend. And of course, seasonality comes into play. Now, as you know, seasonally, December is a bullish month as well. Not as bullish as November, but a bullish month nonetheless. But usually in December, the first half of the month tends to be a bit bearish, but this was actually stronger than usual. But the bulk of the December gains actually comes towards the end of December. We call that the famous Santa Claus rally. Yep. So this is a seasonality chart, and you can see again the December based on history, seasonal history of the S&P 500 is slightly bullish, not as strong as November and October. So again, usually December we've got a bit of a pullback, and then we run to the end of the year. So I think that there's a pretty good chance we should end the year a little bit higher than where we are right now in terms of the markets. What is interesting to note is that if you look at the S&P 500, we have broken above the July high where it started its 3-month correction. So we've broken above that high, but we're still below the all-time high back in late 2021. So would we cross that all-time high? Would the market be able to exceed that all-time high? I think there's a very good chance that we're going to exceed the all-time high either by the end of the year or in January next year. But what's interesting is that the Dow Jones has already exceeded its all-time high. If you look at the Dow Jones index, you can see, lo and behold, give me a second. Yep, you can see the Dow has already exceeded its all-time high. But the S&P has not yet, and the Nasdaq has not yet. The Nasdaq is less than 1% away from its all-time high. Now, if you recall, the Nasdaq actually entered the bear market first back in 2022, and then the S&P followed, and then the last one to enter the bear market was the Dow Jones index. Now it's the opposite. Now the Dow Jones is the first one to exceed the all-time high, and then the S&P 500 and or the Nasdaq index. Now, given the fact that I'm still pretty bullish at least to the end of the year, am I buying stocks? No, I am not buying stocks because in the short term, market is overextended. All right, so I've not been buying any stocks at all for the last couple of weeks because I already bought all the stocks at very low prices in the early part of last year and this year. Early this year and late last year. So currently, like I said, the overall market is short-term, a bit overextended, so I wouldn't be a buyer right here. I would have I'm just holding what I have. Now, neither would I want to short the market, obviously. You never want to short when the market's on a very, very strong uptrend. I always tell people that if you try to short the market that's on a very strong uptrend, it's like standing in front of a freight train and hoping the freight train will stop before hitting you. But most of the time you get run over by this freight train, as most bears experienced this year. So if you look again at the daily candles, you can see a bit overextended. Remember, prices always go up for great companies and for the index, but it doesn't go up in a straight line. It moves in wave patterns. Always remember that. Wave up, wave down, wave up. And sure, it could wave up some more, but I always say never chase the wave up, never chase the girl. Always wait for the girl to run to you into your arms when she's fearful. So always wait for a wave down to add shares when it has retraced to a level of support. So right now is a time when you don't want to be a buyer and you don't want to be a seller. You just want to be a waiter. Well, not a waiter, but just hold your position and just enjoy the ride up. Having said that, there are still some great companies that are still cheap, that are still near buy levels that have not run up yet. For example, healthcare. Healthcare is still beaten down, and I think that healthcare will have a very good year next year, but right now they are still unloved. Especially, for example, stocks like United Health, which is in health insurance, which is one of the core stocks in my portfolio. I have a lot of it, and I'm looking to add more. And you can see that recently, right, wave up, wave down, wave up, wave down, wave up, wave down, and recently it did a wave down right to this support level. So yeah, so you do have stocks like United Health that are still at reasonably attractive levels, and it's undervalued. You can see my intrinsic value is 548, so it is slightly undervalued at 531. So you still have deals in the market that you can look at, right? Another one would be Elevance Health, which is the competitor to United Health. You can see it's also at an attractive level of support, right? You can see, wave up, wave down, wave up, and just wave down to this very nice level of support at the 50-day moving average. And the intrinsic value of ELV is 548, so still pretty undervalued. And of course, a lot of consumer staple stocks are still at reasonable buy levels. For example, you've got your Pepsi, which I just sold a cash secured put on, and I don't mind buying at this level. Now again, these consumer staple stocks are very low growth. They're not high growth stocks, but they are very defensive. And it's great to have some of them in your portfolio, because if we have a recession next year or the year after, these defensive stocks will defend your portfolio, because defensive stocks don't go down that much in a recession. In fact, they may even go up in a recession because they are very defensive. Look at Pepsi. Pepsi is still down, right? And the intrinsic value of Pepsi is about 188. Currently, it's still undervalued, about 167. You've got Procter & Gamble, another very low growth but very defensive stock. P&G, also undervalued, also retraced recently to a support level. And my intrinsic value is 146, so it's just slightly undervalued. And you've got Hershey's Chocolates, which historically is a great performer, outperformed the S&P 500 consistently, but still has not yet rebounded because consumer staples are out of favor. Whereas technology is in favor, but eventually staples will come back in favor when the time comes, especially again, if we have a slowdown next year, if we have a recession next year, staples will be very, very strong. Hershey's Chocolates, one of the reasons it's still down a lot is because cocoa prices have been rising, and that has increased their cost and reduced their profit margins in the short term. But Hershey's has got pricing power. When companies have got pricing power because of a very strong brand, they can raise prices and then maintain their profit margins. Of course, the next question on everyone's mind is that how about next year? I mean, this year the S&P is up over 20%, the Nasdaq's up like 40%. Next year, are we going to have an up year or down year? Are we going to have a recession, or the economy is going to continue to grow, right? Well, I'm going to have a Outlook 2024 event next year, where I'm going to go in depth into what I see happening for the new year ahead. It's going to be a physical event in Singapore, so you're going to fly down and come meet me in our physical event. Yep, we'll let you know more about that, but don't worry, we're going to have an online event as well. But for now, I'm just going to give you some ideas about what I see in the coming year. Now, of course, I always believe that you have to look at both the bull case and the bear case. the pessimistic case and the optimistic case. So now, of course, many bears at the start of this year, they were saying that we're going to have a recession. It's inevitable because if the Fed raises interest rates so much, something has to break. They will definitely break something in the economy. And now that we have no recession, the bears are saying, well, it's because it's a delayed reaction. When you raise interest rates, it's like stepping on the brake of a car that the car takes time to react. It's not instantaneous. And they're saying that next year is when the effects of the high interest rates will really kick in and the economy will inevitably go into a slowdown. Now, of course, with very strong GDP this year, you can't get it growing every year. It has to come back down. It's called mean reversion. So there's that argument that we should have a slowdown next year and maybe even a recession next year. Now, could that happen? Of course, everything is possible. No one can predict the future, right? So that's one argument. Recession next year because of the lagging effects of the high interest rates not being hit yet. So now the Fed is kind of like preempting that, and so they're saying, okay, better cut rates before that recession hits. Could it happen? Of course. Now, of course, there's another concern, which is the yield curve inversion. So people are saying, in history, whenever the yield curve is so inverted, there's always a recession. This time can't be different. Maybe. But remember what I've told you before, that it's not the yield curve inversion, but it's the uninversion that then a recession happens after that. But remember, it's not something that causes something. It's more like a relationship. All right. And you can see this is the 10-year treasury yield minus the 3-month treasury. I like to use the 10-year and the 3-month. It's more sensitive. So whenever it goes below 0, that means the yield curve is inverted, right? The 3-month is above the 10-year. So you can see it's inverted. When it uninverts, then a few months later, we have a recession in gray. Inverts, reinverts, recession in gray. Inverts, reinverts, recession in gray. Inverts, reinverts, recession in gray. Right now, we're still very inverted. Have we uninverted yet? Not yet. Will we uninvert next year? Maybe. All right. So when that happens, when we uninvert, could we have a recession? We could. You never know. It could happen. So of course, that's the bearish argument. Now, of course, there's always two sides of every coin. You have to look at both angles. Now, on the other hand, I've also argued that, something, guys, maybe we already had the recession. It's just that it was not official, where it was officially announced by the NBER, the National Bureau of Economic Research. Because in the past, a recession was defined as 2 negative quarters of GDP, which they then changed the definition, those bastards, right? And we got that. If you recall, in quarter 1 and quarter 2 of 2022, we had 2 quarters of negative GDP. So maybe there's a recession, maybe it's come and gone, right? And so it's like everyone's waiting for the second coming of the Messiah, but he came, he's already here, but you didn't see him. Maybe it's Trump. Who knows, right? I'm just kidding, of course. And then, of course, the other argument is that we already had a recession in terms of corporate earnings. We had an earnings recession that has come and gone. Corporate earnings went negative in these 3 quarters, right? Quarter 4 2022, quarter 1 2023, quarter 2 2023, 3 quarters of negative S&P earnings growth. And in quarter 3 that was just reported a couple of weeks ago, we have now turned positive on the earnings growth of the S&P 500, and it's going to be positive, or projected to be positive, in the next few quarters ahead. So in other words, earnings recession already here, come and gone. We're now moving higher in the world, right? Okay, let's talk about another bearish argument. The other bearish argument people have is that not Adam, but they say, historically, every time the Fed cut interest rates, the market would crash. Every time the Fed cut interest rates, there'll be a recession. Now, first of all, that's not true. There were many times the Fed cut rates, market didn't crash. But yes, there were times that Fed cut rates and market did crash. Let's take a look at a bit of history here. Now, you can see that back in 2000, this is the Fed funds rates in orange, and that's the S&P 500. So you can see, sure enough, when the Fed cut interest rates, stock market crash. When the Fed cut interest rates, stock market crash. Now, but you have to remember that it's not the cutting of the rates that caused the market to crash. It's the opposite. It's because the market crashed for other reasons that forced the Fed to cut rates to save the market. So in this case, what caused the crash? The dot-com bubble burst. A lot of dot-com companies were not making money. They had no profits. It was a bloody bubble. Eventually burst. When it went down, the Fed had to cut rates to save the market and economy. And of course, we had 2011 terrorist attacks as well, right? And in 2008, 2009, what caused the crash? Not the Fed cutting rates. It was the subprime mortgage crisis. It was the overblown property market in the US, and the banks had all these mortgage mortgage-backed securities and collateralized debt obligations that went to zero, and that collapsed the market and the Fed had to cut rates, right? So please remember, it's not the cutting of the rates that caused the crash. The crash happened because of some other stuff, and the Fed cut rates to save it, okay? So if the Fed has to cut rates because of a recession and because the market crashes, and of course that's not good, then sure, we could go down next year a lot, right? But in this case, the Fed is projecting to cut rates even though the economy is still doing well. And the only reason they are cutting rates is because they are seeing that inflation is now under control. They can bring rates back to a more normal level. So the reason they're cutting rates is very different. So bear that in mind. And again, if you look at history, there were many times when the Fed cut rates, market went up. Look at that. Fed cut rates here, market went up. Fed cut rates here, market went up. Fed cut rates here, market went up. So be careful of all this bear porn that you read or you listen to all these prophets of doom, telling you, oh, when this happens, market will crash. No, look at the facts, look at the numbers. It doesn't always mean that. So now let's take a look at the bull case, the bull porn. Let's look at it from a different perspective. Now, when was the last time inflation was super high and the Fed had to keep raising rates to bring inflation down? That was back in the 1980s when I was a teenager. So at that time, this was the S&P 500. That was the induced bear market, like our induced bear market of 2022 and going to 2023. And then you can see the S&P bottomed 12 August 1982 during the 80s. And then Volcker, who was the Fed chairman at the time, he declared victory. Okay, I'm going to stop raising interest rates. He declared victory here. And after that, the market went up 34% in the next 12 months. This time, the market bottomed in October last year. If you guys recall, that's when this bull market began. So right now we are about 14 months, 12, 13, 14. Yeah, we're 14 months into this bull market, right? And right now, our Fed Chairman Powell has declared victory, right? Okay, we're not going to raise rates anymore. I'm done. So there we are. So if this continues like it did in the 1980s, hey, could we have another 34% return in the next 12 months? We don't know, right? But hey, it is possible. The other thing that's interesting is this. So far, as the bull market is in the 14th month, have a lot of retail investors and institutional investors, have they joined the bull market? Have they put all their money into equities? No. Many people still have their money in cash, in money market funds. In fact, right now, there's about 8.3 trillion in money market funds enjoying high interest rates. They're thinking, why should I put my money into the stock market when I can get risk-free interest rates in money market funds, in cash deposits? So a lot of money is there. And in fact, you can see that in a year where the stock market has gone up over 20%, institutional and retail money market funds have increased at a high. So people are all parking their money in cash and not in the markets yet. And you can see equity mutual funds and ETFs had a net outflow during 2023. So what does this mean? This means that a lot of investors are not yet in the market. Their cash are on the sidelines. And as interest rates start to come down next year, what's going to happen? They're going to think, oh shit, now I'm getting less interest on my cash. Eventually, they're going to pull out their money from the money market funds, from their deposit accounts, and put it into the market, and that would add even more fuel to the stock market next year. The other interesting thing is this. Next year will be the second year of the bull market. Now, historically, the second year of a bull market has always been positive, going back to 1949. You can see that in yellow is year one of the bull market, year two is the second year of the bull market. And in every single case, the second year has been positive. There's never historically been a second year of a bull market that was negative. So again, will it happen this year, next year? Well, no one knows for sure, but history is on the side of next year being bullish. And the average return of the second year of a bull market is 12.6%. So will we have a recession next year, or will the economy continue to grow the next year? We can't tell for certain. And that's why the most important thing as an investor is not to invest based on making predictions, because we can't predict for certain. Anything can happen. The most important thing is to have a portfolio that will do well regardless of what happens. Regardless recession or no recession, cut interest rates or no cut interest rates, our portfolio must continue to do well. And the only way to do that is to only hold high quality companies that are interest rate immune as much as possible, that are recession immune as much as possible. And these are many of them would be the tech stocks that are in secular growth industries, your Microsofts, your Meta, your Amazon, for example. And also ensuring that you have a good mix of not just growth stocks, but defensive stocks as well, like your Procter & Gamble, your Pepsi, your healthcare stocks, so that even in the event that we do get the recession next year, because you've got a good mix of defensive and growth stocks, your portfolio will have lower volatility and you'll be able to grow even in an event of a recession, right? That's the most important thing. Now, again, even though we are still in the early years of the bull market and we expect the bull market to continue, I wouldn't be a buyer of all stocks right now, because like I said, many stocks right now, they are short-term overbought, overextended. And I always strictly follow my rule that I only buy a stock if, number one, it is undervalued, never chase the girl when it's run away, always wait for it to retrace to a level of support where you enter at a lower risk level. So a good example is Microsoft. Now, my intrinsic value for Microsoft is $376. So currently at $370, it is not cheap, but neither is it very expensive. It is fairly priced. Now, I'm not going to buy any more Microsoft because I've already got a lot in my portfolio. It's one of my biggest positions. But if I wanted to buy Microsoft, would I buy it right now? I would. Even though I know that the market will continue to likely go up in the next couple of years as we enter the second, third phase of the bull market, right? Because take a look, it's a wave up, it's a wave down, and right now it's a wave up. So we never want to get in on a wave up. We always want to wait for a wave down to at least an area of support where we have got a margin of safety when it's at least undervalued before we start adding to a position. Yeah, so it's always having that discipline, only have high quality companies, buying only when it's undervalued, waiting for price to come to us and not chasing price. If you do that as an investor, you will do very, very well, right? So again, a very quick sharing. A lot more that I'm going to share in my Outlook event in 2024. We're going to have a live physical event in Singapore. If you're in Singapore, do join us. If you want to fly in from out of town, we welcome you. If not, we're also going to have an online event. And again, we're going to give you more details in the next couple of days. So with that, I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.